We last spoke in November 2010. Things have changed a little bit since then, unfortunately in a negative direction. But first let me start with the good news. Growth for Bangladesh in the fiscal year 2011, that is just about to finish in June, we continue to project that at about 6.2%, and that's up from 5.8% in the previous fiscal year. Now, why do we continue to project a pretty decent rate of growth? First and foremost, it's for consumption. Consumption has received a boost from public and private wages. Both of them went up. Investment is likely to have increased, as we will see, as we have seen in a pretty significant increase in the rate of capital imports. And agriculture performance is also expected to be good, and that will feed into consumption. Then what are the stresses that are emerging in the economy? Well, the first one really is on inflation. Inflation has steadily crept up. It is the latest figure for March 2011 is showing that the consumer price index overall has increased by 10.5% year on year. And as far as food is concerned, it's almost 14% increase for food inflation. The next element in terms of stresses emerging is the current account situation. Exports have increased very significantly, 40% in the year up to February 2011 versus only 4% last year. But imports have also grown by 37% in the first half of the year. Along with that, there's also been the pressure of rising food and fuel prices and the pressure of that on the budget. And then remittances, which are very significant for Bangladesh, they grew by only 4% in the first 9 months of fiscal year 11 versus 19% in the same period last year. This is primarily because of a decline in the net outflow of migrant workers. So as a result of these stresses, the fiscal year 11, the current account deficit, we expect it to end with a 0.8% of GDP deficit. Last year, the figure was a surplus of 3.7% of GDP. So there's a huge swing in the current account deficit. The next element of pressure is on the budget. As we have already noted, both food and fuel imports have gone up. There's a subsidy associated with both of these. On the food side, in addition to the value of the prices of food going up, there's also been a very significant increase in the quantity of food imported as the government tries to take social safety net measures. Despite these pressures, the fiscal deficit will manage to stay well below the target of 5.5% of GDP, somewhere around 4.5%, which will be more than last year's 3.7%, but nevertheless it will be contained.